Hello, everybody. Ed Yardeni here. It's May 15th. How time does fly. Mother's Day weekend here already. I remember when it was New Year's Eve. Anyways, I hope you all had a very pleasant weekend, Mother's Day weekend. Sunday, the weather was magnificent here in New York, Long Island, and we got another really nice day today. So hopefully this is the beginning of a very nice spring. I really don't like it when we go straight from winter to summer, but so far we have a few days of spring here, and I hope it's nice where you are. Hope you're also doing well in the markets. It's been a bit of a treacherous game here since the market hit an all-time record high on January 3rd of last year, but it's been pretty good since October 12th of last year, as the market has managed to rally quite nicely. Still a big debate out there, I guess, about whether the bear market's over. I think it ended on October 12th. I don't think we're going to retest that level. And that's mostly because I think the economy is proving to be quite resilient. It's doing remarkably well, given that we've seen a 500 basis point increase in the Fed funds rate since early last year. There's more talk now about trying to explain why the economy is doing so well. And one of the answers is that there's still plenty of liquidity left over from the excessive amounts that were provided during the lockdowns and the pandemic situation. People saved a lot, and they also got lots of checks from the government. The government's also funded lots of infrastructure spending, lots of incentives for onshoring, as well as for Green New Deals. And that money is going to continue to pour into the economy. You know, it's often mystifying to me how, so from a macroeconomic standpoint, whether it be the Wall Street or the financial press, the focus always seems to be on the Fed. And I don't really have a problem with that. I wrote a book on Fed watching a couple of years ago. Hope you guys read it. But what's always seemed to be missed is the impact of fiscal policy. By the way, I think the Fed made a big miss in that regard, because when they were asked, what do you think about fiscal policy over the past couple of years, all the officials said, that's not our bailiwick. We don't comment on fiscal policy. But it has to have an impact on monetary policy. If you've got extremely stimulative fiscal policy and you provide extremely stimulative, ultra easy monetary policy, you're going to get what we got, with the benefit of hindsight, a big inflationary surge. Then again, if you tighten and start to first tap on the brakes and slam on the brakes and kind of wonder, well, why isn't this bringing inflation down faster? Why isn't it slowing the economy down faster? It might have something to do with the fact that fiscal policy remains extremely stimulative. Then again, I think there's way too much focus on the macro, whether it be fiscal, monetary, or both. I think we often ignore the resilience of the economy itself. That is the resilience of people like yourselves and myself. We go to work every day trying to do what we do as well as we can for our customers, for our families, for ourselves, for our country. And so there's millions of people working hard every single day who have come to recognize that fiscal monetary policies can be a kind of annoying, have annoying impacts on what we do, but we've kind of learned to deal with it. I've often said that it's amazing to me how well the economy does despite Washington. And I still think that is a useful way to think about, put everything into perspective. Well, speaking about putting things into perspective, let's talk about the subjects of today's morning briefing, which is disintermediation, disinflation, and dystopia. Dystopia, of course, is Washington, D.C. That's where all the dystopia starts. Unfortunately, it doesn't necessarily end there. But with regards to disintermediation, that's a big issue, whether the banking crisis that started in early March 8th, 9th, 10th, whether that banking crisis has been stabilized by the Fed's provision of ample liquidity to the banks. And a lot of it is trust and confidence. I made an analogy to the movie A Quiet Place. In A Quiet Place, a family has to avoid making any noise, and all they can do is sign language to each other because there's some terrible creatures from outer space. This is a true story. It's a movie that was released a couple years ago and did quite well, and we did see it. But the family can't make any noise. They got to signal each other with hand signals, and if they make any noise, they risk being devoured by these creatures who happen to be blind, but they have amazing hearing. What does this have to do with disintermediation? Well, it's don't say a word. Don't utter disintermediation. Don't utter the notion that maybe this isn't going to work and people should get out of deposits. So far, so good. Where we did see a deposit run for 3 banks, major banks, and that has had an impact on the macro numbers because they were big numbers. But taking them out, I think we still have a relatively calm situation in the banking sector, not one that I think is quickly morphing into a credit crunch. Now, we all lived through 2008, and we recall how 2007, 2008, we all recall how one domino fell, toppling another and another and another. So it's still conceivable that we're going to have troubles, which is why we're all watching the weekly data so carefully, and we'll look at that in a minute. On the disinflation front, it looks like pretty good news. It looks as though we're still disinflating. I think, benefit of hindsight, inflation is in fact turning out to be quite transitory in the goods sector. It's the services sector that's more persistent. But look, if inflation continues to decline in the services area by the end of this year, and we get down to 3 to 4% in the consumption deflator, as we think, then I think all in all, it wasn't that persistent. And the markets sort of got spooked by it all in the first, 10 months of last year. And that's when October 12th, we made a low in the stock market, and October 24th, we made a high in the bond market. So that's not a terrible outcome if in fact we've all calmed down about the inflation fears, and the Fed's done enough, and there's enough forces in place to bring inflation down. Well, let's look at our charts here, just to review with more detail what I'm getting at. So here's the chart collection for today, May 15th. Now, every single Thursday afternoon, we get data on the Fed's balance sheet. So that gives us the first indication of whether this credit crisis, banking crisis, is morphing into a credit crunch. And here you can see total loans. Total loans consist of primary credit, which is what we learned in school was the discount window. And you can see the discount window borrowing really jumped up when the banking crisis first hit, and now it's come down almost down to zero. Meanwhile, this new facility, the Bank Term Funding Program, it was zero on March 12th when it was announced, and now it's up to $81.5 billion. These are big numbers, but in the grand scheme of things, they're tiny. Meanwhile, the other credit extensions is, I think, almost all loans that the Fed provides the FDIC to restructure the banks that the FDIC has gotten in receivership and is trying to basically sell their pieces. So far so good, right? I mean, it'd be nice to see this thing coming right back down again, but it's not going to until the FDIC stuff comes back down. Meanwhile, you look at the combination of the bank credit funding and the other, and the primary credit, it's not that big a deal. Well, most importantly, of course, is what does this actually mean is going on with the banks? And that data we get on Friday afternoons at 4:15 from the Fed. And this is the latest data we got on Friday. And as you can see, this obviously is consistent with what we just looked at. The banks' borrowings by all banks looks like it's stopped going up. I won't say it's peaked, but it's stopped going up after jumping with the banking crisis. Meanwhile, securities are coming down. Securities held That isn't necessarily, I mean, some of that could be SVB having been forced to dump its securities. But I think from here on, it's mostly maturing securities that aren't being reinvested and instead are being used as a source of liquidity to make loans. And here you can see loans kind of looking a bit toppy here. But loans, by the way, are a lagging indicator of the economy. So, you know, I think it's important to look at it every single week, but we have to keep in mind that, you know, a lot of things can hit the fan before loans can convincingly demonstrate that there's a credit crunch. So we'll know it before the loans tell us. Nevertheless, we want to watch them. And here's deposits. And this is what everybody's kind of getting all upset about is deposits are declining. But look at the trend. This is on a ratio scale, logarithmic. So you can look at the trend and you see that, I don't know, we're getting kind of close to the trend, but we're not quite there yet. So some of this is kind of reversion to the mean in terms of deposits. It's not disintermediation per se, though obviously some of that is disintermediation. Not a clean-cut story, obviously. Here's the loans by categories at all the banks, and you can see that consumer loans, all-time record high. Go figure, residential real estate, all-time record high. They don't make most of these loans. Maybe they just keep the really good stuff for themselves. But to a large extent, they sell these loans to Fannie and Freddie. But that's at an all-time record high anyways. And then you're seeing some peakish looking developments in commercial and industrial loans. Keep in mind, these are highly correlated with inventories. And we know that inventories piled up in an unanticipated fashion late last year, second half of last year. And that this year, companies haven't been piling up inventories. They've cut back their orders. They've been discounting. So maybe they just don't need as much to fund their inventories. So that doesn't necessarily reflect a credit crunch if it reflects mostly an inventory management. And then there's commercial real estate, which has got everybody worrying. And that looks kind of toppy, but a lot of that's held by insurance companies. Quite a bit of it's held by small banks. So there is risk for the economy. There's risk maybe more for the regional economies. Meanwhile, the financial markets, you can see that we've been looking at this chart for a while and kind of were puzzled that bond yields were staying so low here. And as inflation soared, and then this past year, we saw that the bond yield started to really take off, got up to 4.25% on October 24th, as inflation was starting to moderate. And maybe by around that time, the market started to sense that inflation was moderating, coming down. And keep in mind that when we look at the bond yield versus the actual inflation rate, economic theory and just makes sense. And what you really want to do is compare the bond yield to expected inflation, your own expected inflation. Would you buy a bond at 3.5% based on what you think inflation will be over the next 10 years? Now, multiply that by millions, billions of people who, let's make it millions of people who are making that same decision. You can see that a lot of people came to the conclusion that this was pretty good evidence that we're moving in the right direction and that we might continue to see this thing drop. And again, I think by year end, 3 to 4%, that's the end of this year, 2023. By the end of 2024, we could be down to 2.5 to 3%, the way things are going. I know that's a fairly contrary view that people think that inflation is not going to moderate, but it certainly has moderated in the good side, and I think we'll see it moderate in the service side as well. Stock market also, same kind of action. In this case, the forward PE, the blue line made it slow on October 12th, and the forward PE has been marching higher. The bears say, well, there's no way this bear market's over at these levels of PEs in the mid-teens, and so it's a good point. I'm not telling you it's wrong, but just when you think you got this market figured, it kind of surprises you. And I think just as everybody figured that the mega cap 8 were finished, that they had an unusual run. They came back because they demonstrated that all they really had to do was cut costs and their profits would zoom. These are very, very profitable companies if they want to be. If they want to take a lot of that cash and invest it in the future, that's what they were doing. And then the market kind of got spooked by costs going up faster than revenues. And people like Zuckerberg said, well, wait a second, my company's worth a lot more than that. Let me show you what my earnings are if I cut back on expenditures. So that's had a tremendous rebound. We're basically back at 18, which is quite phenomenal. Take out the mega cap 8, and I think you get 16.5 on the S&P 500. Not exactly cheap, but closer to fair value of, let's say, 15. And then over here, again, you see the correlation, an inverted correlation with the bond yield. Let's look at inflation here. I got a couple of good charts here showing you the relationship of the CPI year-over-year percent change. So that's this number, and that's that number, the blue lines. And you can see a fairly good correlation between the CPIs, and in this case, the ISM non-manufacturing services price index, and pushed ahead by 3 months. And so here we are down at this level. And I know you can always kind of fool around with these charts and come to different conclusions, but we lined up the 0 line for the CPI year over year and the 50% line for the NMPMI. And it looks pretty convincing that if this relationship it's obviously not a perfectly tight relationship. It's been pretty tight here. If it remains relatively tight, we could be down to 3 to 4% by July. Now that seems like, extremely hard to believe that by July we're going to see the CPI down to there. And I made an analogy. You know me, I like movies, so I made an analogy between the inflation story and the It's a Wonderful Life Christmas classic, and said I kind of doubt that we're going to have a happy ending by the summer. But here's another chart that says we're going to have a happy ending by September. This is the CPI again versus percent planning to raise average selling prices. This is the NFIB small business owners, and you can see that there's their indicator with a 5 months ahead lead time. So by September, we should be down to 3% or 3.5%. I'll take that, and I'll take 3 to 4. I'll take 3 to 4% this year with 3% by the end of the year. Here's another one. This is the personal consumption, and there's, people aren't aware of this, but the PPI actually has a personal consumption number now. It's got goods and services, just not rent. So keep that in mind. CPI has rent, PCED has rent, and you can see that the PPI for consumption excluding rent is 2.7%. That's pretty good, and we all know that rent's kind of got some statistical issues, and that tends to be a laggard. So it all adds up to inflation continuing to moderate. Here's the rent numbers, and often we look at the year over year, which kind of looks toppy, but you can't say it's a peak. It could always go there again. But we also look at the 3-month percent change annualized, and statistically speaking, it's a pretty good argument to say that if the 3-month at an annual rate is coming down, that's going to put downward pressure on the year over year. So the rent, I think, and here we're talking about April, and I've got until the end of the year. I'm not looking for July or September for it to be a wonderful life. By the end of the year, it could be a wonderful life, and the market could very well be anticipating that. Another wonderful thing happening here is energy inflation on a 3-month basis has been negative for quite some time here. The year over year is actually down 5.1%. Look at food. Food was a persistent problem, but transportation costs are coming down, energy costs are coming down, and farmers do respond to high prices by producing more. So here you see that the inflation rate for food is down to 1.7%. I think this is all great stuff. And here is what's not so great. This is what the Fed's been talking about, the PCED core services excluding housing. They're always looking for trouble. I guess that should be their job. They forgot it there for a while when they got behind the inflation curve. But we have data through March for the PCED. The CPI just came out last week, And I guess the closest we can come to that concept is CPI services, excluding energy. So that's the core, and food's not in there. It's services. But I think I think when you go to a restaurant, it's in there. But take out energy and shelter, you should be pretty close to the PCED concept, but of course it's not exactly identical. And this one is showing more of a peaking than this one. This one's kind of stuck here, which is what Powell has been talking about for the past few months. So let me wet my whistle and let me unshare here, and let's go to some questions. I got two so far from Ian and Kevin. Let me know if anybody else has any questions. We don't have to fill up the whole half hour, but I'm always here for you. So Ian, what's your take on why Congress has not passed immigration policy to bring in 2 to 3 million people missing in the workforce? The Fed is not the resolution here, as we will continue to have a structural deficiency in applicants without more supply of labor. Well, they are coming through. We're talking about millions of people are coming through illegally. The progressive wing of the Democratic Party is pushing the Biden administration to change its work rules, so anybody who comes across the border can start working right away. And of course, quite a few may very well be working off the books. Who the heck really knows? You know, I don't really know what the difference is between illegal and legal immigration these days. You know, if you want to come in through New York, you've got to do it legally. If you want to come in through Canada, you've got to mostly do it legally. I guess it's still a big border. But if you come in from the southern border, you're in the U.S. Well, welcome to America. The immigration policy is just a horrible mess. I don't know why it's so politicized. I mean, it does make sense to bring in immigrants in a organized, lawful, legal, process-based approach in order to relieve the labor shortages in this country. And a lot of them happen to be in lower skill kind of work. And that doesn't necessarily mean that all the immigrants that are coming are lower skilled. A lot of folks from Venezuela are coming just because they want to get the hell out of there. You know, it's a mix of people from all over the place. It is unsettling in my mind to just have an open border like that, but I'm not going to get into that whole mess, which continues. But I think it will prove to be a source of labor one way or the other, and I won't be surprised if the Biden administration starts changing the work rules. Kevin, if the data supports inflation coming down from last year's peak, what are your views on growth or stagflation? What does this mean for risk assets? Well, I think it's basically favors risk on rather than risk off. If the Fed's done raising rates, which is my view is that raising rates by 25 basis points the past 2 times was nuts, because that occurred right after the first ones occurred within a few days of the beginning of the banking crisis. I mean, the Fed kept talking about that they wanted to raise rates to restrictive. I think the banking crisis proves that they got to restrictive 50 basis points ago. But I think they'll come to their senses, and I don't think they're going to raise interest rates anymore. I did read their financial stability report, which came out about a week ago, and it was very relaxed. You know, no anxiety, no real concern about the banking crisis. So maybe they're too relaxed about it. But I think they're done. And I think that favors risk assets again. And I think people are starting to look at the rest of the decade. And who knows? I might be able to write more and more about the roaring 2020s again. I started out the decade talking about the roaring 2020s, and bam, the pandemic hit, and all the shocks and shock waves from the pandemic. And it didn't really look like it was too smart to say that the decade is going to, on balance, be the roaring 2020s. But I think with this AI hype or reality, we're going to see more and more talk about the technology revolution that's coming. And people are talking about how this could be exponential technological innovation. The internet was sort of exponential, but people are talking about even more exponential. Okay, let me just turn that off. Okay, so Roberto, is the market pricing in 25 basis point cuts later this year? Well, I was just looking at the 2-year. The 2-year is 4%, and the 2-year is a leading indicator for the federal funds rate. So I would say that say that if your question is 25 basis points, 2 of them 50 basis points, I'd say yes, and I'd say and maybe another 50 basis points in 2024. So the answer, in my opinion, is yes. Okay, we'll do just Brian, and then we'll call it an early end. Okay, Brian, do you have any updated ideas on how bad or how long the politicians will wait before raising the debt limit? Also, how much pain might we have to endure before they come to an agreement? I haven't a clue. I mean, this is a kabuki play. It's political theater. We'll see how it plays out, but apparently they are talking, they are negotiating. Our friend Jim Lucier at Capital Alpha is probably one of the best Washington watchers when it comes to watching the political ins and outs of these things. And in the morning briefing today, we had a long piece by Jim, and he had a fairly constructive view that this will be done as they have been in the past. And that this too shall pass, and we'll find something else to worry about. Well, with that, hope you don't have too many worries. Hope you have a good week, and hope it stays sunny on your end. Let's do this again next week.